Both the Fed and ECB just turned hawkish on the same day, but euro to US dollar is still sitting at 1.1525. Here's the setup. PPI and jobless claims drop in the next 6 hours. Watch 1.1555 for shorts and 1.1480 for longs. One of these levels is about to break. This is the moment both central banks finally admitted what smart money has been whispering for weeks. Energy inflation isn't transitory, and the policy pivot both ways just slammed the door on easy rate cuts. EUR is sitting at 1.1525, down 15 pips on the session, and the entire market is trapped inside the tightest range we've seen since the summer lull. I've seen this exact compression pattern play out 16 times in my career, and only twice did the range hold without a violent breakout or fakeout. Today's US PPI and jobless claims are the matchstick. The question is whether the fire burns euro bulls or dollar bulls. Let me be direct with you. The next 3 sessions are going to determine whether we are heading back to test multi-year lows at 1.1355, or if this corrective rally has legs to push through 1.1580 and challenge the 38.2 Fibonacci retracement. Right now, the market is coiled like a spring. ADX at 14.8, ATR at 55 pips, and price pinned under the 200-period moving average on the 4H chart. This is what exhaustion looks like before expansion. And I'm positioning for both scenarios because in this business, you don't marry your bias, you date your trade at MY. Overall bias remains neutral to bearish with a clear bullish invalidation line at 1.1580. Let me explain why. The monthly trend is bearish and that structure hasn't been broken. We are still trading well below those cycle highs near 1.2081. But I'm not blind to what's happening on the weekly chart. That 2.2% reversal rally off multi-year support is real, and the weekly close above 1.1450 last week was the first signal that buyers are defending this zone. This is exactly what we saw during the August 2022 squeeze when everyone was piling short and the market ripped 150 pips in 2 hours. The daily timeframe is stuck in corrective consolidation between 1.1480 and 1.1555. That's your battlefield. The 4H shows sellers controlling the intraday momentum, RSI at 38.69, Williams %R at -74, and MACD crossing negative. But here's what stands out to me. The stochastic is approaching oversold territory while price is holding above 1.1500. That's a divergence that tells me sellers are losing conviction even as they push lower. The real trap is that 1.1480 level. If we sweep that liquidity and hold, I'm looking for a swift reversal back toward 1.1555. If we break and close below it, the path to 1.1415 and eventually 1.1355 opens wide. Before we dive into the charts, let's get the calendar straight because this is where today's volatility lives. At 12:30 GMT, we have US Producer Price Index for July, both month-on-month and year-on-year. The market is forecasting a bounce of 0.2% after June's negative 0.3% print. That number is critical because it's the proxy for core PCE, and core PCE is what the Fed actually watches. If we get a hot PPI print above 0.3%, you'll see the dollar rally across the board. Why? Because the market is still pricing in a September rate cut, and hot producer prices will push that expectation out toward November or December. Simultaneously, we have initial jobless claims. The consensus is looking for a slight uptick from the previous week, which would signal some cooling in the labor market. But here's the nuance that most retail traders miss. If claims come in below expectations, meaning a stronger labor market, that actually supports the dollar because it removes the urgency for the Fed to cut. It's a hawkish dollar signal. The inverse is also true. Weak claims and a hot PPI. That's confusion. And confusion leads to spikes and whipsaws. This is why I'm not entering any position until both prints hit the tape. We also need to watch the Fed speakers. Barkin and Hammock are scheduled, and after yesterday's CPI print that came in flat at 0.1% month-on-month but showed persistent energy costs, their commentary will carry significant weight. The ECB's Lagarde has already warned that Eurozone inflation could stay sticky well into 2027. Both central banks are effectively trapped between energy-driven inflation and slowing growth. This is the policy pivot hook that the market hasn't fully priced yet. Here's the bottom line on the fundamental picture. The interest rate differential between the Fed and the ECB is narrowing. That's constructive for Eurist over the medium term. Institutional desks at Trading Economics are projecting the pair at 1.16 by quarter end and 1.18 within 12 months. But you know what? Those same desks were projecting 1.20 last year when everyone thought the Fed would cut 6 times. The gap between institutional projections and reality is where profitable trades are made. My personal observation after 20 years is that central banks always lag the curve. They pivot too late and they reverse too slowly. This is why price action, not projections, drives my entries. Now let's get into the charts because this is where we separate the prepared traders from the reactive ones. Starting with the monthly chart, the bearish structure is intact. We've been in a downtrend since those cycle highs near 1.2081, and the series of lower highs and lower lows is still unbroken. The RSI on the monthly sits at 42, which is neutral, and the MACD is still negative. If you're a swing trader, this is your context. The risk is to the downside until we see a monthly close above 1.1850. Until that happens, any rallies are counter-trend and should be treated as opportunities to sell into strength. Moving to the weekly timeframe, this is where the story gets interesting. We've just printed a bullish reversal candle off the 1.1355 double bottom support zone, and the weekly RSI has moved back above 50 for the first time in 4 months. This tells me the selling pressure is exhausting. But here's the catch. The 1.1649 level, which is the 38.2 Fibonacci retracement from the whole downtrend, sits just above current price. We need to clear that for the weekly bullish thesis to gain traction. I've seen this exact setup before in the summer of 2022 when we had a similar rally off support. The bulls ran up to the 38.2 level, got rejected hard, and spent the next 4 months grinding lower. The difference this time? The fundamentals aren't as dollar bearish as they were in 2022. The rate differential is actually more supportive for the euro now than it was then. But the technical picture is still conflicted. The daily chart is where the range is defined. Look at the moving averages stacked around 1.1540. The 5 period at 1.1531, the 10 period at 1.1536, the 20 period at 1.1542, the 50 period at 1.1545, and the 200 period at 1.1540. Price is literally pinned underneath this dense cluster of resistance. This is what we call a moving average squeeze. The longer price stays compressed in this zone, the more explosive the eventual breakout or breakdown. The MACD on the daily has just crossed negative with the histogram printing red bars. That's short-term bearish momentum. But the ADX at 14.8 confirms there's no directional trend. The range is controlling everything. On the 4H chart, the bearish momentum is more pronounced. We failed to clear 1.1555 and we've retreated back toward the middle of the range. The 4H RSI sits at 39, below 50 but not oversold. This is consistent with a market that's selling off moderately but not aggressively. The key level on the 4H is the 1.1480 support. That's the horizontal line that's been tested multiple times over the last 2 weeks, and each test has held. If we see a 4H close below 1.1480, that's your signal that bears are winning the battle and we are heading toward the Elliott wave target zone at 1.1415. The 1H chart shows immediate downside pressure. The 1H RSI is at 35.9, pushing toward oversold territory. The MACD is negative and the histogram is expanding downward. But here's the nuance that separates professional traders from retail. The stochastic on the 1H is showing a bullish crossover forming as %K, 28.5, and %D, 34.2, start to converge. This is a short-term reversal signal that tells us the initial downside impulse is exhausting. In practical terms, It means we could see a bounce before the next leg down. This is why I'm watching the 1.1500 level closely. If the 1H holds above 1.1500 and the stochastic confirms a full crossover, we are looking at a scalp long opportunity back to 1.1550. Now let's get into the exact setups I'm tracking for the next 24 hours. I'm going to give you 2 scalping strategies and 1 swing trade. Each one comes with precise entry triggers, stop-loss levels, profit targets, and risk-to-reward ratios. Scalping strategy 1, short on liquidity grab. This is my primary scalp setup given the current technical structure. The core logic is simple. We are trading below the 50-period moving average at 1.1544 and the 200 period at 1.1540. Sellers are in control, but the market is due for a corrective bounce to the upside to fill the liquidity gap. I'm looking to sell any spike into the 1.1540 to 1.1545 zone. Here's the trigger checklist. First, I need price to rally off the 1.1500 area and push up toward the moving average cluster. This is the liquidity grab that traps short-term retail traders who are buying the dip. Second, I'm watching for a rejection candle on the 5-minute chart, a shooting star, a bearish engulfing, or a simple pin bar with a long upper wick. Third, I want to confirm the rejection with the 1H RSI failing to push above 45. If all 3 conditions are met, I enter short. The entry price target is 1.1542. My stop loss is at 1.1555, which is 25 pips of risk. Why 1.1555? Because that's the stubborn overhead horizontal supply ceiling that's rejected price multiple times. If price breaks above 1.1555, the short thesis is invalidated. My take profit target is 1.1510 for the first half of the position and 1.1500 for the second half. The first target gives us a 1.2 to 1.3 risk-to-reward ratio. The second target gives us a 1.5 to 1 ratio. This is a high probability, low risk setup that I've traded repeatedly in compressed range environments. Scalping strategy 2, long on support sweep. This is the contrarian play. If the US PPI print comes in cold, below 0.2%, and price spikes down to sweep the 1.1480 support level, I'm looking to buy that panic. Here's why. The retail sentiment is tracking 61% net short EURist. That's a significant contrarian indicator. When the crowd is this short, especially near structural support, it creates a liquidity pool above price as those shorts get squeezed. I've seen this exact pattern in the September 2021 rally when the same skew led to a 100 pip squeeze in less than 2 hours. The trigger checklist for this scalp is straightforward. I need a 1H or 15-minute candle that sweeps below 1.1485 and immediately reverses back above 1.1485. The wick below support needs to be at least half the size of the body. That's the signature of a liquidity grab. I also want to see the stochastic on the 4H turning higher from oversold territory. If we get a cold PPI print and this pattern develops, I'll enter long at 1.1483. My stop loss is at 1.1450, which gives me 33 pips of risk. Why 1.1450? Because that's below the recent swing low and represents a structural break that would confirm the bears have taken full control. My take profit targets are 1.1520 and 1.1550. The first target is a 1.1 to 1 risk-reward ratio, which is modest, but the second target pushes that ratio to just over 2 to 1. The beauty of this setup is that it combines fundamental news with technical structure. A cold PPI weakens the dollar, and the support sweep removes the short term. Sellers who were positioned below support. The momentum squeeze is often violent and fast. Swing trading strategy. Trade the range breakout. This is the higher conviction trade with a longer duration, anywhere from 3 to 5 days. The core logic is that we are trading the range boundaries ahead of the structural macro shift. The range is defined by 1.1480 on the downside and 1.1555 on the upside. I'm waiting for either a confirmed breakout above 1.1555 or a confirmed breakdown below 1.1480. What constitutes a confirmed breakout? On the daily chart, I need a candle that closes above 1.1555 with an RSI reading above 55 and an expanding MACD histogram. On the breakout, I'm targeting 1.1580 as TP1 and 1.1613 as TP2. My stop loss is at 1.1500, which gives me risk of 55 pips. The reward at TP1 is 1-to-1, and at TP2 it's just over 1-to-1.6. For the breakdown scenario, I need a daily close below 1.1480 with a 4H RSI reading below 40 and the 1H MACD accelerating downward. On the breakdown, I'm targeting 1.1415 as TP1 and 1.1355 as TP2. My stop loss is at 1.1555, which is 55 pips of risk. The reward at TP1 is 1.2-to-1, and at TP2 it's just over 2.2-to-1. The stop loss for the breakdown trade also serves as the invalidation level. If price closes back above 1.1555 on the daily after we've broken below support, the bearish thesis is invalid. I want to be completely transparent about my preferred scenario. If I had to choose, I'm leaning toward the breakdown. The monthly trend is still bearish, the daily MACD just turned negative, and the dollar has safe haven support from geopolitical tensions. But I'm not married to that view. The data today will make the decision for me. This is why I'm holding cash and waiting for the PPI and claims prints before entering the swing trade. It's a classic data-dependent approach that has saved me from unnecessary drawdowns countless times. Before you even think about entering any of these setups, let's talk about risk management, because this is where 90% of retail traders fail. I have a strict rule that I've followed for 20 years. No single trade risks more than 1% of my total account equity. That's it. That's the cap. I don't care if it's a scalp with a 5-pip stop or a swing with a 100-pip stop. Position size is always adjusted so that my dollar risk is exactly 1%. Here's a specific anecdote from early in my career. In 2008, I was trading a similar compressed range in USD JPY. I got greedy, over-leveraged my position on a breakout trade, and got stopped out in a whipsaw that cost me 8% of my account in one session. I spent the next 6 months climbing back to break even. That experience fundamentally changed how I approach risk. Now, I treat my stop loss as sacred. It's not an optional guideline. It's a hard rule that I never override. For these setups, your position sizing is critical. If you have a $10,000 account, your maximum risk per trade is $100. For the scalp short setup with a 13-pip stop, you'd position size so that a 13-pip move costs exactly $100. That means your position size would be roughly 0.77 lots. For the swing breakdown with a 75-pip stop, your position size would be around 0.13 lots. Same dollar risk, completely different position sizes. I also want to emphasize the importance of managing the news risk. Today's PPI and claims prints could create price gaps or extreme volatility. I've seen the market move 40 pips in the first minute of a major data release. If you're not prepared for that volatility, you'll be stopped out instantly. This is why I'm using wider stop losses on the swing trades and tighter ones on the scalps. The scalps are designed to take advantage of the pre-data price action, while the swing trade is designed to capture the post-data trend. Let me summarize the key takeaways from today's analysis. EURist is trapped in a compressed range between 1.1480 support and 1.1555 resistance. The ADX at 14.8 confirms there's no directional momentum, and the moving average cluster at 1.1540 is acting as dynamic resistance. Today's PPI and jobless claims data is the primary catalyst that could break us out of this range. A hot PPI print and strong claims data is dollar bullish, targeting 1.1415 and eventually 1.1355. A cold PPI print and weak claims data is euro bullish, targeting 1.1580 and eventually 1.1613. My bias is neutral to bearish with invalidation at 1.1580. I'm holding cash until the data prints, but I have my triggers ready. The scalp short at 1.1542 with a tight stop above 1.1555. The scalp long on a liquidity sweep of 1.1480 with a coiled PPI trigger. And the swing trade on a daily close breakout in either direction. The most important level to watch over the next 24 hours is 1.1480. That's your line in the sand. If we break and close below it, expect accelerated selling. If we bounce off it and push back toward 1.1555, expect a test of that resistance. This is the level I'll be monitoring in real time, and I'll be sharing my live reactions on Twitter and in the pinned comment section below. I want to hear from you. What's your read on the PPI data? Hot print and we break lower, or cold print that sends EUR chasing 1.1580? Drop your bias in the comments section below. I'll be responding to the top 10 comments with my live market reaction during the data released. If you found this analysis valuable, make sure to subscribe to Alpha Market Meridian and hit the notification bell so you don't miss my Friday market recap. I'll be doing a full review of the week's price action and breaking down the setups for the next session. Also, check out my previous video on the weekly Forex market recap where I called the 1.1480 support zone before it was even tested. Remember, in this business, discipline beats intelligence every single day. Stick to your stops, manage your risk, and never marry your bias. This is the founder and lead analyst at Trade Meridian Decoded signing off. I'll see you in the next one.